nominally, there's another point to add to this. You just skipped $52.6 thousand of interest, changing nothing about your lifestyle. You didn't add any more money. You didn't make more income. You didn't budget better. None of that. You changed nothing about your lifestyle, and you just knocked off 50 grand off this mortgage. So the first thing I want everybody to start thinking about is, instead of interest rate, is what does principal cost? Right? Okay, I got a 5.3% interest rate, or I got a 3.2% interest rate, or a 6.7% interest rate. Okay, cool. What does the actual dollars coming out of your pocket to pay for that money, what does it end up costing? And I want to show this from the perspective of the first part of a mortgage. And I meant to say this earlier, I forgot. I'm emphasizing a mortgage because typically this is the biggest expense that anyone has in their life. And this is where most of that, interest is the second biggest expense that you have in your life. This is where most of that's coming from. So if we look at, let's say, the first $5,000 of principal in a mortgage, in this particular mortgage, which, do you guys see my mouse as I'm moving this around the screen?
Yes.
Great. So here, as we make these payments, this shows how much remaining balance there is. So if we come down here, this is roughly $5,000 of balance has been paid off, and it has taken us 11 payments, it looks like, to get there. What did that $5,000 cost? Well, the exact amount of principal we've paid down is $5,111.96. We get that from summing up these numbers here. The exact amount of interest that we've paid off, we sum up the interest, is $19,321.46. Total is about $24,000. And if you do the math, that means of the money you paid at 5.3%, this relatively low interest rate, right? 79% of your money went to paying interest. Or said otherwise, each dollar of principal that you paid, you had to pay an additional $3.80 in interest. Which, I mean, if you do the math that way, what is that? 380% interest? Let me compare this to a revolving line of credit, right? This would be a credit card is a revolving line of credit, and a line of credit is obviously a revolving line of credit. Let's compare that same amount of money, $5,111.96, on a line of credit at 18%. So here's where the spreadsheets start coming up. So I'm go through this slowly because I know you throw somebody a lot of numbers and there's just a lot of numbers on the screen. So I stuck in 18%. Let's have the starting balance be the amount of money that we paid in the prior example with the mortgage. We'll make monthly payments similar to the monthly payments that we're making on the mortgage. And if we end up doing the math on month one, we end up with about $77 in interest, make a payment. Month two, $44 in interest. Month three, $12 in interest. We pay it off in 3 months, and the total interest paid is $133.05. Or otherwise said, 2.5% of the total money that came out of your pocket went toward paying interest. Or 2 points. I think the math came out to 2.6 cents per dollar, as opposed to $3.80 per dollar, even though I more than tripled the interest rate. So the reason for this, obviously, is, as I described the math before, the interest rate, I mean, how much money that you have left on the balance is what the interest rate is being applied to. Clearly, like we took a very large amount of money and applied a 5.3% interest rate to it, comparing it to a very small amount of money that we applied an 18% interest rate to. But again, the way I'm encouraging you to start thinking is not what the interest rate is, but how much money you paid for that specific principal. So in order to start understanding how we can leverage these two ideas, leverage these two products against each other, we need to understand the kind of the basics of how these work. So in an amortized loan, this is what most people are used to, is you got money You make a payment and it's gone. You can't get that money back. The bank eats it. It's gone. These are one-way payments. And if they're on a schedule, like if you make some early, the bank doesn't care. You still owe the next one the next month. You have to pay according to the schedule, regardless of any extra payments that you made. And if you get behind, you owe everything that's behind. Compare this to a revolving line, like a line of credit or a credit card. And if you've got this line of credit and you've got this is an accurate representation of everyone here. I can see that. The way that you use a line of credit is you make a withdrawal, right? If you've got a $15,000 line of credit, you don't immediately start paying interest on $15,000. You pay interest on whatever you pull out. So you make a withdrawal, and at some point you make a payment and pay it back. Now, this operates exactly like another financial product, but the words are different. A checking account works exactly the same way, although you got to put money in first before you can take the money out, right? And then instead of calling it a payment, you call it a deposit. However, and my apologies, I know there's a lot going on the screen. On the left, we have the line of credit example. On the right, we have the checking account example. In terms of the functional difference between these two things, the only thing I can think of is one goes negative and one goes positive, right? If I say, hey, instead of living out of my checking account, I'm going to live out of my line of credit. And when I get my income, instead of putting into my checking account, I'll put it into my line of credit to pay it off. Functions exactly the same way. I mean, you got to pay some interest on the line of credit, but again, in terms of the money coming in and money going out, functions exactly the same way, except that on one side we call money going in payment, and on the other side we call money going in deposit. So how do we leverage these two against each other? Let's take that same example that we had for the loan. We got this $400,000 home loan at 5.3%. And let's say we also have a $25,000 line of credit at 18%. And we're going to take $15,000 out of that line of credit and pay off $15,000 of principal. Like we just got the loan. Like we just got it today, and then we're immediately going to go to our line of credit and boom, pay off $15,000 in principal. What does that look like? Now, we just saw, actually, no, we didn't see this. You're going to take my word for it, and you're going to do the math later. That the first $15,000 of this loan costs $54,000 in interest. The first $15,000 of the loan costs $54,000 in interest. So on this loan, if you take $15,000 and immediately apply it to principal, you just skipped $54,000 of interest in the schedule. Now we stick that on the line of credit. But now what? There's a problem, which is I got another loan I got to pay off, right? This is where you start to learn that you weren't taught how this stuff works. So watch this. So let's make up what your monthly household finances look like. So let's say you're bringing in $8,000 a month in income, and you got $6,500 a month going out in expenses, meaning you have $1,500 a month left over in cash flow. If we were to say, okay, instead of using a checking account for our money going in and out, we're going to now use this line of credit for money going in and out. So we now have this $15,000 balance on our line of credit. At 18%, if that whole $15,000 sits there for the whole month, we're going to add up $225 in interest. And now, when we take that $8,000 and stick it into the line of credit, that just made our payment. In this case, the deposit is the payment. So in terms of like the monthly pressure that's put on your monthly cash flow, in this weird sense, it doesn't affect it. Because normally you'd say, okay, I got this $15,000 credit card essentially, and it's going to make, it's going to want $400 a month or whatever. Now I just added $400 a month to my monthly expenses. Well, you didn't, because your deposit is making that payment. So at the end of the month, okay, now we got to take $6,500 out for all our expenses. Our month two balance is $13,725. Oh, I said that like I was going to have sense at the end of it. It's $13,725. How many months would we have to live out of our line of credit before that thing gets paid down to zero? Well, I made a handy spreadsheet for that. So each bold line here is, what you're starting out with each month. And you'll see, here are the numbers that we just saw. We get an additional $225 in interest. We deposit our income. We withdraw our expenses. And then the next month, there's $205 in interest. And the next month, there's $186 in interest. And we go down, 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 down until month 12. There's $125 left in owed on the account. For the sake of this argument, I'm going to say that's close enough for horseshoes. We're going to call it zero. And over the process of that time, you paid just under $1,400 in interest. Am I losing anybody? I'm going to keep going. So let's compare what just happened. On this new line of credit, that's triple the interest rate, we took away $54,000 from the mortgage. $54,000 of interest from the mortgage, and generated $1,400 of interest in the line of credit with triple the interest rate. Nominally, there's another point to add to this. You just skipped $52,600 of interest, changing nothing about your lifestyle. You didn't add any more money. You didn't make more income. You didn't budget better. None of that. You changed nothing about your lifestyle, and you just knocked off $50,000 off this mortgage. And these are realistic numbers, right? I mean, it's not realistic to get a $400,000 house in Seattle anymore, but I'm guessing somewhere it's realistic to get a $400,000 house. 5.3%. I mean, that's even a little low, right? And 18% is actually a little high. I got a line of credit through a credit union right now, and I think I'm at 8.9%. So I got a line of credit that's half the rate of this. Which, I mean, I don't even know how much that would affect, because I mean, that turns it into $700 instead of 1.4K. I mean, it's the rate, when you start talking about it this way, doesn't make as big of a difference as you think it does. Now, again, obviously you want the lowest rate possible in a vacuum. But once you understand how leveraging these things against each other works, the interest rate no longer becomes the big thing. It's just a component, one component in the math. So what's the catch here? Like, what the hell did you just see? Because I remember when the first time I saw that, so I was like, wait. What the heck was that? I missed something. There is something you missed, but it's not as bad as you think. So paying the mortgage off normally, that 1.5 or that $1,500 a month cash flow that you have would have gone to savings. And you simultaneously would have paid that $54,000 in interest on the mortgage. In this accelerated version that I'm describing, all of your money is going toward paying that loan, right? There's no savings account that's increasing in this story. However, how much money would have gone into your savings account? Well, it's $1,500 times 12 months. It would have been $18,000. So if you've saved $54,000 and you had to spend $18,000 to do it, the real savings here is $36,000 in that 12-month period. Now, there's a cooler thing to even add on to the end of this. If you've heard of a HELOC is a line of credit that's secured by your house. Now, there's two main differences between a HELOC and a normal line of credit. And those main differences are you're going to get a lower interest rate because it's secured by real estate. And it's going to be a lot bigger because the line of credit I showed before was just some unsecured line of credit that the bank is willing to cross its fingers and take a gamble with you. With a home equity line of credit, they'll go, oh, hey, we'll give you a percentage of the equity, right? I mean, if you've got $150K left on the loan, the house is worth $400,000. You've got $250,000 worth of equity. We're willing to give you a $200,000 HELOC. You know, what is that? 75? No, 80% of the equity right there. Yeah, it's 1/5. So what if you got that HELOC, paid off the entire mortgage with the HELOC? So essentially saying you're going to take the debt owed over on the mortgage and move it to debt owed over on the HELOC. And you start paying down the HELOC the same way I just described with the line of credit. Well, your expenses just dropped the amount of the monthly payment of the mortgage, which was $2,221.22 a month, meaning your cash flow just turned into $3,721.22 a month. Meaning, I did the math off screen. You do the math and you can corroborate this on your own. You pay off the loan, the remaining amount of the loan in 4 years instead of 7. If everybody who's watching this now or recording could like, share, and subscribe it helps us out a lot.
Yeah.
I hate saying it, but it's just true.